Joining us now, Pierre Ferragu, analyst at New Street Research. Pierre has a buy rating on the stock. He upped his price target to $900 this morning. Pierre, good timing. Congrats on that. Why up to 900 and why today?
Hey, Wilfred, thanks for the question. So why today? Well, our job is really to do fundamental analysis and catch these opportunities where the market is getting concerned by like shorter term risks and catching that moment, the market will start looking back at longer term perspective. So today the stock is down with the rest of the market, more than the rest of the market, because investors are concerned about things like market share losses in Europe. Investors are concerned about delays in the ramp up of new factories in Europe and in Texas. And we think these concerns are very short-sighted. And the reality is that delays in production are not going to stop Tesla from being able to produce 2 million vehicles annually in 2023. And when we get there in 2023 with 2 million units, what we see in the traction Tesla is getting today is that there will be more than enough demand to sell these cars. So Tesla will still be supply constrained at 2 million units. That's what we take from seeing the success of Model 3 in the US that is now very well established, how strong the ramp of Model Y is everywhere else in the world. And so on that basis, we think in 2023, Tesla will be in a position to print $12 of earnings per share. And that flows directly from 2 million units. So our high conviction is 2 million units. And that's more than 50% above where expectations are today. So that means we'll have like 2 years of very, very strong earnings revision. And so what we see happening in the next 12 months is short-term concerns are going to get behind us because these delays in factory ramp-ups, these market share losses in Europe are things that are not going to last very, very long, just maybe a couple of quarters. And beyond that, we'll have a very, very steady stream of earnings revisions. And what you see is that Tesla today, considered like a hyper-growth stock, is probably going to maintain a multiple between 50 and 100 times earnings. And that's how you get to this like fairly exciting target price of $900 in a year from now.
It's still down for the year and for the month, and in a bear market, if you want to quantify it that way, down 25% from the highs. Pierre, isn't the last few weeks an indication of how risky it might be and how tied it might be to the move in treasury yields, the rotation into value stocks, and everything else that the market has been focused on so far this year? Yeah,
so I think there is an element of like more of macro market related risks that can impact the stock. I tend not to look at that. Like as an analyst, what we do with the team is really bring like the fundamental perspective, and we let our clients who are like a portfolio manager, fit that in their broader picture. So yes, of course, very high growth is very highly valued at the moment. Do we have like a fundamental issue with that? Probably not. We like a lot very high growth stock. What we bring the picture back, we constantly bring the picture back to fundamentals, and look at Amazon in 2011. In 2011, none of what's happening today was happening. But when the market realized Amazon would grow 20, 30% a year for years and years, the stock re-rated to above 100 times earnings. And then it stayed between 50 and 100 times earnings for a decade long. And this is our call on Tesla. And of course, that call tends to transcend, what's happening at the moment in the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.